great future. We're talking real money.
May you live in interesting times. An English expression that was falsely attributed to a Chinese curse because of the apparent irony of interesting denoting troubled times as opposed to good times. And ladies and gentlemen, I want to say the curse has come true. We live in interesting times, particularly when it comes to economic, financial, and investment news and information, because we've gone from a relatively calm couple of years in America and around the world to nothing short of abject confusion. Nobody knows what's going on from not one day to the next, 1 hour to the next. We got tariffs.
It's 1
we
minute.
Got stocks.
1 minute.
Oh,
it's that tight. I got to say it. Yeah. And I mean, here's the thing about all this, and welcome to Talking Real Money. I'm Ton. That's Don.
Yeah.
Our telephone number is 855-935-TALK. Right? I think that's right. Anyway, this has been, look at the numbers. In 2 days, April 3rd and 4th, the S&P 500 lost 10.5%. That is about what it makes in a year. And then it turned around on April 9th and made 9.5%. I mean, that is wacky up and down. And the key to survival of all this is trying to think clearly, trying to think more long term, trying not to focus on the short term, because our brains in these volatile situations, according to the people that study such matters, want to look at things and say, okay, now I understand and I know what to do.
Our brains, I honestly think they get overloaded and they short circuit when all of this kind of stuff is going on, because we don't really understand fully. I bet if you asked 100 people, you wouldn't find 50 of them who knew what tariffs really mean, who know what these. I bet you wouldn't find 20 of them who knew what this stuff means and what its effect could have been on stock markets and bond markets. Now, economists know that.
Sure.
But apparently they're missing some of those in the White House. They seem to be short a few economists. Because if you
there's
ask
some debate over the previous actions, yes.
A debate? No, there's no debate.
Oh, there are economists who are supporting tariffs and the additional
we got a
tariffs.
whole bunch of them who...
It's hard to find, but they're there.
They're really, really hard to find. And the fact of the matter is that you see the whole thing falling down. But the problem is this creates uncertainty, which makes the stock market behave badly. But that's one of its roles in our life, I believe. I read an interesting piece that said the financial markets, although they weren't really considered by the founding fathers of America, have kind of become a fourth branch of government.
Wow. That's ascribing a great deal of power to traders.
Sort of a check, another check and balance in the system. And think about it. Maybe that's kind of what they do.
Where they act so poorly that the people in power go, wait, I got to do something about it. I don't think it was that, by the way. I don't think it was stocks, and we'll talk about this in a minute. I think that was about the bond market, which we'll touch on. But
I do. We're going to touch on the bond market a little later, but let's talk about the stock market for a minute, because many of us, I hope most of us, have some money in equities in our retirement plan. Most of us have our equities in our retirement portfolios, whether they're tax advantage plans or just regular accounts. The money we're saving for the long term, that's what stocks are good at. And that's the question that I think still needs to be very clearly answered for investors. I read a piece this morning about one investor said, I went 100% to foreign stocks.
What?
He went all to foreign because he thinks the U.S. is getting a bad reputation.
There are some asset classes in foreign stocks that are above water still when you compare to the S&P 500 being 10% down. So buying
but should we be doing anything? Should we be reacting?
No, okay, that's the fair point. And that, by the way, I was out of town for a very short trip, saw a lot of people I haven't seen in many years, and that was everybody, of course, would find out you're in the financial sector. What's going on?
Oh, yeah.
What do we got to do? Yeah, what do I do now? So we'll talk about that in just a moment.
So you told him what to do, right? I hope.
I did,
We'll
and so far I've been watching the trading. They haven't done it yet, so you got to get with it, folks.
855-935-TALK. If you have some questions about your money, we would love to answer them for you.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
To our show, the phone number here is 855-935-TALK, 855-935-8255. I'm Don, that's Tom, and yesterday Tom made the long trip across the mountains over to Walla 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 Walla, Washington, to his Lilliputian College to attend an event at which he was asked the question, well, you're a financial guy. What do we do now?
Yeah, and everybody wants to know that, right? Especially in turbulent times. And, of course, you know, without looking at anybody's money, we're going to tell you not to do anything emotional, because this is always I got to do something. No, that's a bad idea that you jump in and do anything when you're feeling this way. But I really like the advice that Jason Zweig dished out this week, because he had 4 questions about all of this. What do you own and why do you own it? I think it's a great question.
It really is anything. When
you really think about it, why do you have that? What's the purpose of that?
And to make money is what most people will say. Oh, to make more money.
Yeah, you got to dive in a little deeper. He was there talking also about rebalancing your portfolio, taking from things that had gone up more to things that hadn't gone up as much, rebalancing. But then he asks question number 2, why do you own stocks if you own stocks or equities? What's the purpose of those? Is it because you want to benefit from the stability of trade agreements between U.S. and the rest of the world? Probably not.
I didn't even think about that. No.
Yeah.
When I bought stocks, I went, oh, thank God we have stable trade agreements.
Yeah.
I didn't think of that. Although now I look back longingly for those.
Happy to re-sign up. I mean, you're the guy who always says this, and I think it's spot on. You really buy stocks to take advantage of long-term growth of companies in the U.S. and overseas.
The economy.
That's what you're really.
It's really simple. It's actually simpler than the companies. You're buying the economy of the world, because we know that in aggregate, given enough time, the economy of the world has grown pretty steadily for about 2,000 years. That's a decent amount of data.
And that includes, world conflicts. That includes Great Depressions. That includes
Dark
pandemics. All those kind of things have happened. Then he says that leads to the third question. Okay, so, yeah, you own stocks because they've grown. Yeah, you're diversified because that makes sense. So in his mind, what's the third question? Well, what has changed? Yeah, the Trump trade moves have damaged much of the world's trust in the United States. You look at the dollar and bonds for that. But he correctly points out, and this is so hard when you're in the middle of these things to think long term, but long term, markets and countries have been remarkably resilient. I think that's so important to remember.
Yeah, because what's great about that knowledge, we have that knowledge going way, 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 way back. What's great about that knowledge is that it allows you, if you have the right mindset and the right plan in place, to take advantage of the reason that stocks have returned more than safe investments. There's a reason they've returned more. We're seeing it right now. What we've seen is the reason why you get rewarded for stocks, because at times they scare us.
And yet everybody ignores that fact. They think they just continually go up day after day. No, they don't. Day by day, it's a little over 50% of the days are up and the days are down. Months, it's like 75% of the months versus 25% down. So, okay, so then he goes.
The reward, though. Hold on. The reward.
Yes.
The reward is for those who have control over their emotions. That is the key to being rewarded for what appears to be the fright of the stock market, which, looking way back, isn't that frightening? Go ahead.
Yeah, okay, so that takes us to the fourth question. If you didn't already own this asset, would you buy it at this price? He talks about what they call anchoring, and that is when you look at something and say, wait a minute, at the first of the year it was worth $10,000, and today it's only worth $9,000. What's going on here? Why? And you did this last week, Don. You talked about, a couple of years of performance have actually been pretty good with stocks and bonds. But if you're anchored to a recent price, that could make you make some really bad decisions. I think these are spot on and will hopefully help you get through what I still think is more chaos ahead. I don't think it's going to get a whole lot easier. That was the other message I gave to people last night.
Our problem as human beings is, it's emotions on both sides. The fear that causes you to sell when things go down, but the other side of the coin, and this is what makes a lot of people crazy in a market like this, is the fact that you want to have all of the gain. You want all of the upside when it goes up, none of the downside when it goes down. Then you want to be back for all of the upside when it goes up and none of the downside when it goes down again, because you know that had you been able to do that, well, you would be just filthy stinking rich, which is why you can't do that. Because everybody can't do that. So therefore, there's no way for us in aggregate as people to buy low, sell high, buy low again, sell high again, buy low again, sell high again. We can't do it.
Well, and in fact, you can look at the numbers because at last Monday, in one of the really big downdrafts, 10 times as many trades as an average day in 401ks. And guess what people are doing? Selling stocks and moving to cash. The numbers show you right there. Bad decision.
Yeah, and we'll talk a little bit about that move to cash for some investors. Even that didn't work out so well for a little while. 855-935-TALK is our phone number, 855-935-8255. Let's head north to Canada. Jeff, welcome back to the show.
Hey, guys. How are you this weekend?
Good, Jeff. What's up?
I'm just following up on, my brother actually called last weekend, and I'm just following up on the question that he had.
Was he at the one at the Blue Jays game?
Your brother? Oh, that's right. It was the Blue Jays game.
That was a couple of weeks ago, but no, Dan, my brother, called last weekend.
Okay.
He's taking over. Well, he's actually taking it over now, his blue chip stock portfolio, and he was talking to you guys about converting it into ETFs.
Oh, yeah. I remember now. Yes.
Yeah. So here's the question that sort of was going around in my mind. I think you guys were of the opinion, and I agree, that regardless of the market turmoil that's going on, he should just sort of stick to the plan, sell his blue chip stocks, and get into the ETF market. Mm-hmm. Yep. I believe that was your opinion.
That's right? What I said. Yep.
Yes. So I'm wondering if he should just sell everything on Monday because he's got full control now, and buy on Monday, or if he should sort of dollar cost average, not reacting to the market turmoil, but say like selling a quarter of it in 1 week, next week selling the next quarter, the next, like do it in like quarters as opposed to buying and selling all in like one day.
This is in a retirement account though, right, Jeff?
Yeah, it is.
Yeah, so there's no tax ramification, right?
No, exactly.
I'd do it all at once.
You're really moving. I would do it all at once. You're moving
because it's a lateral move.
Yeah, it's no different. And by the way, what's he going to do with the green chips? Because you're going to do this with the blue chips. What are you going to Green chips, red chips. What all kidding aside.
I hope your internet keeps working because I'm leaving.
Exactly. So,
no, it's
we
lateral.
would just say make the sells, make the buys, same day as if you can do that. If you can get the settlement that quickly, then get on with it. Yes. Yeah,
just get on with it because it's better to not have those individual stocks really long term because of the trouble they individually can get into.
Tom and Don are talking real money.
The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. The Department of Defense is working with Google to help secure America's digital defense systems, from establishing cloud-based zero-trust solutions to deploying the latest AI technology. This is a new era of American innovation. Find out more at g.co/American innovation.
For your real life and real future, Tom and Don are talking real money.
Those of you playing along at home, it's Canada 1, the United States nothing. So if you're in the United States, you might want to call us. We need to
the score's
level that out.
We're going to tie the score.
Oh, okay.
Right,
just checking. Yeah. Okay.
No, I'm looking at the score.
Go U.S.
We got somebody on third waiting to come on in.
Perfect. We're all
set. With this pitch. 855-935-TALK. That is a phone number to call us, and we'll talk about money with you. Or baseball. I don't care. You're not going to get very good baseball answers, but we'll do it if you want. Let's go to Connecticut. Bill, welcome to the program.
Hi, Don and Tom. I've got a two-part question related to how I was helping my brother-in-law planning for retirement. We had a bit of a communication gap.
Uh-huh.
He wanted to be 60. I kept checking with him on being 60-40, 60-40. But he never checked his balance, and 60-40 was his contribution. So over a few years, he probably drifted to 75-25. Mm-hmm. And, of course, when the last week or so hit, he had a bigger loss than anticipated, which is when I found out he needed to scroll down and actually see the account.
This is such a great lesson.
Go to the next page.
This is such a great lesson, though, Bill, because people forget
he hasn't
that they've
finished
got
his question yet.
I know, but I just want to cut in very quickly because most people forget I'm contributing in this amount, but the market's doing what the market does. So you got to rebalance that. That's
right.
Absolutely. I see this every day where people forget about that completely.
Yeah, and on the one hand, he did do much better than he intended to do because the market went up, and now he took a bigger hit than he intended. So my first question is, he thinks he should wait until this all calms down, or should he rebalance? He wants to get down to 50-50 because he's retiring next month.
Yeah, that's pretty dramatic to go from 75-25. That might be.
I would probably spread that out. I maybe do that because that is a big
trade. Yeah,
that's a big drop.
Go ahead, Don. Yeah, I'd do a trade now and maybe another trade in 3 months or something. I mean, just to spread that out a little bit. But yes, get to it. Don't wait.
Okay, so ease it down over time to 50.
Yeah, but don't try to time it down. Start now. Start now. Like, for example, go to 70-30. Then go to 65-35. Or excuse me, 65,
that probably works. Yeah,
65-35.
And then go to
60-40.
The market already took him. The market already took him under 70-30. So
good. Well, then the next step is what I would probably do just in two steps. Go to 60-40 and then go to 50-50 in a month or so after that.
Yeah.
Okay. That's a good idea. I hadn't considered that.
Just make it disciplined. Whatever you do, make it disciplined. You have to have absolutes. Otherwise, our emotional brain causes those dates to wander around. Oh, just wait a little bit.
Yeah. So the second question is, you're going to retire at the end of the month. And I had told him, well, you can move your account over to Schwab. And as you can see, we should probably do something very simple. And I was wondering if just a VT and a VND two-fund retirement thing to start with would be sufficient.
Or a target date.
Yeah.
Target retirement.
It's easier. Then he's not going to run into that problem he just ran into again, where he didn't rebalance.
He'll never run into that if he has a target retirement.
So if he did a 20-30 or something.
Hold on, let me figure out which one is the 50-50.
And that's probably 2030 or maybe 2025. I'll bet you it's close to that. So, I mean, you do something like that, it's all done for you.
Retirement,
and you don't have to worry about it.
30, I'm going to check that fund. Hold on, I want to make sure that we're in the ballparky. No, it probably is going to be 2025, it looks like.
Okay.
Hold on, I got to pull it up just to be sure. Yeah, and that way it takes then the emotions are totally wrung out of it, and the portfolio, yeah, that's where you want to be. Is it 2025? It's a 50-50 portfolio, and bear in mind that it's basically like buying VT and BND, because it's the total stock market, it's the total bond market, it's the total international stock, and it's the total international bond with, by the way, some tips thrown in for good measure.
You got to love that, Bill. Thank you for calling. And by the way, you could do us a favor. Run by headquarters. They're back there in Connecticut and put in a good word for us. We'd like to keep our jobs, if you don't mind. Really, that'd be nice of you. Thank you.
Yeah, that's not going to have any impact. We're old.
Tom and Don are talking real money.
This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem. So why wait to hire the people your company desperately needs? Use Indeed's sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
Welcome back to the show. I'm Don McDonald, 855-935-TALK, 855-935-8255. Love to spend a little time with you here talking about your money, 855-935-TALK. And let's go to East Point, Florida. Joe, welcome to the show.
Well, you mentioned on a few minutes earlier, you said, do not go into cash. That's the wrong thing to do. I want to know your reasons why you don't want to be in cash.
Well, because if you're moving from stock, you're saying move from stocks and bonds into cash? That's what I was referring to. Are we agreement on what we're talking about here?
No, I don't have any stocks or bonds. I have nothing to do with the stock market or bond market or treasuries or anything that has to do with the government at all.
Okay. All right. Well, leaving that, that discussion aside, here's the reason that we do not advocate a move from one type of asset to another at a time like we've had recently. Number one, it implies it's an emotional decision, not a financial one. Number two, if you have a plan that says, here's what I'm trying to do with my money, and in the long term, I'm trying to attain this kind of return, willing to take this much risk, you don't pay attention to the day-to-day action in the market, because here's part three. We can tell you without a doubt that the people that do that end up with less money. Study after study after study shows in aggregate that they just don't have, they make the wrong move at the wrong time. That's why we do not advocate a move from assets like stocks and bonds into cash.
It's market timing.
Okay, I understand. I'm sorry?
I said it's the equivalent of market timing. It's trying to predict something that we can't possibly predict. The future.
Yes. Okay. I understand that. Thank you. Now, I just wanted to say I'm not into any of those things. I'm just in real estate, and I have been for 52 years, and I've become very, very, very rich because of it.
It's something you're good at. That's great.
Good.
For some people,
we know it.
Yeah, it's your business, correct?
Yeah. I mean, I'm not a broker or anything.
No. But you have for 50 years built a business, basically, of buying and selling real estate at a profit, correct?
Yes, but never rolling it and whatever they call it, rolling it. I don't believe in that. I never do that. I keep it, and then eventually maybe I sell, and I watch my taxes vary like a hawk, and I do the right things.
So most of the properties, you're managing properties and you're renting them out for an income stream.
Well, I did that in the early days. I don't do it anymore. I don't like rentals either because of what's happened with COVID.
Yeah, okay. But what I'm saying is for you, that's the right thing. Just as it, Jeff Bezos got rich building a business. Warren Buffett got rich building a business. You got rich building a real estate business, and building businesses is one of the best ways to get rich, but it's also, as I'm sure you can attest, hard work. You didn't just lazily do it, did you?
No, we work our tails off. Sometimes we had 2 jobs we were working.
There we go.
Paycheck, and then you get into go home and get busy on the real estate.
But for people who have some extra money laying around, Joe, and this is the point we're trying to make, if you have extra money and you're trying to save it for retirement and you have a full-time job that you're putting in 40, 50, 60 hours a week on, you don't want to then get into real estate as a sideline. You're too busy. So you can put it in stocks. You won't get as rich as you got with your business, but people do and have gotten pretty wealthy buying stocks.
It was a hobby to begin with, but we did have a full-time job, and we finished that at noon, and we went and worked on the real estate like mad dogs the rest of the day until it was dinner, and we had dinner, and then we went to bed and went back to work.
Good for you. Congratulations on building the wealth, and thanks for the call, and appreciate you being out there and listening. And please, if you're listening right now or you listen anytime, call us on Saturdays from noon to 2 Pacific time at 855-935-TALK.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, there have been a number of victims of the game of Tariff Chicken that is being played around the world. And it is a game of Tariff Chicken right now.
It's a joke. It's a joke, says China. It's a joke. Except it's not,
but one of the things that I think a lot of people were concerned about was that it would hit the stock market. I mean, my wife thought about this a long time ago. She goes, should I get out before these tariffs? Well, no, I said, but I'll probably catch trouble for that.
You know
soon,
what?
But I will catch HE double hockey sticks. Anyway, there was, I don't believe a lot of people considered another possible problem with engaging in a trade war with the rest of the world. And that is the fact that the rest of the world has been for many years investing trillions and trillions of dollars in U.S. debt securities, U.S. Treasury securities, and they decided, well, maybe we should sell those. Yeah, and you saw what it did to the bond market.
Well, a lot of pressure on the bond market. I don't think it got the attention it deserved. You had to kind of read past the headlines because
a lot of economists saw it, but it wasn't because it confuses people. I think the reason you don't hear about the Treasury market and what happened to it is because people get confused about why bond prices move up and down.
Yeah, well, we could discuss it if you'd like, but let me give you a number first, because I believe in about a week The Dimensional Fund's Intermediate Term Government Bond Fund, which is one I look at as kind of a benchmark, DFIGX, lost 2% in a week. It went down a whole, which is really, really fast for any bond fund. But that one that is, and I say this relatively conservative because it's made up of U.S. government debt, which has always paid you back with the interest promised. And even though what our U.S. our rating is only AA or something, I mean,
AA plus. We're AA plus. AA plus. So we got a plus.
Pardon me. Yeah.
But I'm telling you, Australia, the EU, Austria, Switzerland, they all have higher credit ratings than we do. Canada has a AAA. We don't.
Yeah,
we don't.
That's shocking. But this is. In some ways, if you want to worry about something, and I don't recommend you do because there's not much you can do about it, this is probably a bigger worry. I mean, and this is, if you, again, read carefully, one of the reasons why some of the tariffs got pushed out by 90 days, because people said, wait, people are selling our debt. What's this going to do to the dollar, et cetera, confidence in the U.S. government. So the question then becomes, and it came up last night in one of the discussions I had with somebody at this gathering I was at. Okay, so if you're not going to own U.S. government debt as the kind of the ballast in your portfolio, what are you going to own?
That's the problem. We pretty much, actually, we don't have to own it. I believe there are two. I think we need to go back to the basics. There are two things that impact the price of a bond in the period between when you buy it and when it matures. If you buy it and it matures, you get all your money back. The price does not fluctuate up or down. If you buy it when it's new and you sell it when it matures, you don't have any fluctuation. It's along the way that you have fluctuation. If you want to sell that 10-year treasury before that 10-year treasury matures, the price is going to go up or down. For example, a $10,000 10-year treasury over the past month went from $10,000 all the way up to $10,150 in early April to last Friday, it went down to $9,930.
Wow. So that's like 10%
that's intermediate term treasuries.
Yeah.
Huge fluctuation. That is unique. So that's one of the things. As interest rates change, and what the reason interest rates changed, they went up because people were selling bonds. So the value of the bonds the yield increases as the value goes down. So the other thing that it impacts them is currency, are the currencies of the countries. If the U.S. dollar becomes less valuable, our yields on our bond funds are going to have to rise internationally to make them competitive. Though you're an American investor, that currency exchange doesn't impact you. It does, except for the yield changing. The currency exchange itself is not going to impact how many dollars you have to spend. You'll still have the same number of dollars to spend. So that's why I like U.S. denominated bonds for my portfolio primarily, but there's nothing wrong, and you probably should even have a little bit in high-quality foreign bonds because their quality is as good or better than ours.
Yeah, I think if you looked at my portfolio, our portfolios, you would be about 70% U.S. government debt, or a little less because we have some investment-grade corporates in there, and then the rest would be international. So you get a little bit of that diversification, not unlike what we believe with stocks. Just sort of globally diversify, give yourself some additional protection for when one part of the world looks troubled. And I think we have to be honest with ourselves and say that's what the United States has looked like the last couple of weeks.
Yeah, we have to the rest of the world, whatever you believe politically, okay? Come on, it's a fact. To the rest of the world, we look like we're a little bit crazy. Like we can't be counted on. Now, that may be part of the president's brilliant strategy. Yep. Honest to goodness, I hope that's correct. But I don't have a lot of faith. I'm sorry.
It's hard to know.
Don't.
It's just hard to know.
I don't. Yeah. And it's because I listen to the learned people of the world. I listen to people like Jamie Dimon, who's been in the financial business and been very successful at it for a long time. I listen to Nobel Prize-winning economists, not to some guy who ran a hedge fund. Although Bill Ackman, who was a big supporter of Trump, is saying this is a big mistake financially. You're hurting the U.S.
Most of the people in that arena have said they hate these tariffs. So yes.
They've changed their mind. The Wall Street Journal's very conservative editorial staff, their editorial board, is up in arms over these tariffs and what it's doing to the position of America in the financial world. We were looked up to, even though we had a AAA plus or AA plus rating on our bonds. Still, U.S. bonds were considered to be the gold standard, the platinum standard of bonds in the world, even though other countries have higher ratings than we do. We were, and hopefully will be again, considered to be the strongest country economically on the planet.
And with all of that, the question still is, what would you do differently? And I don't think I would do much differently today than I would have done 2 months ago, especially when it comes to fixed income. And
that, my friend, is the bottom line.
Yeah, I mean,
if you invested right, if your portfolio was already U.S. and international, if you already had the right stock-to-bond ratio, even though bonds fluctuated, the bonds didn't fluctuate nearly as much as stocks did. They were still a safe haven, even with that volatility. It wasn't a big loss. So if you have the right portfolio in place, then you can weather almost any storm as long as your attitude remains what it was prior to the trouble that affected your portfolio. 855-935-TALK is our phone number. You can call us every Saturday from noon to 2 Pacific, 3 to 5 Eastern, no matter where you are.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hello again. Welcome back to the show. I'm Don McDonald, along with Tom in his fancy studio now.
Yeah,
where he has reincarnated the Model Military Aircraft Museum.
Room for more planes, of course.
Oh, you have lots of room for planes. Yeah, you don't have as high a ceiling, though.
No, I don't
know where that B-2 is going to go. That B-2 is going to whack you right in the brain.
That's already mounted in the garage, and I think it'll stay right there. So it's too big for this room.
Too big, so it's moved to the garage. Yeah. Sorry, B-2.
Yeah.
It's probably obsolete soon anyway, so.
Oh, stop it.
Be replaced. I read that somewhere about there's like a hypersonic in development or something, a hypersonic bomber.
There's always something in development. So
hypersonic. Yeah. Anyway, we are here to help you all the time. You can call us at 855-935-TALK on Saturdays. You can go to talkingrealmoney.com and you can ask questions using the contact form there. You can either record them or write them. And then there's this guy who's just like nuts about actually talking to you over there. That guy.
Are you talking about me now?
I was pointing right at you.
Why you're kind of? I didn't know if somebody behind me or something. So
right.
Yes,
Is there anyone behind you? No.
Well, I'm always checking. No, yeah, it's a fun part of my life. I'll be honest with you. I get to talk to so many of you. So yes. Happy to do so. Happy to have you chat with me and maybe one of our advisors. We really try to be straight up about your situation with you. We do a free portfolio analysis. We'll give you some help around planning if you'd like it. So yeah, that's a fun part. And so I guess you're asking me to tell people how to do that, which is pretty doggone easy.
You don't have to. No, you do not have to. I am not making you do anything. But if you want to tell them to go to talkingrealmoney.com and click on the button that says meet an advisor to set up a meeting with you or any of our advisors, that's free with no obligation and no high-pressure sales pitch, you can certainly do that if you want.
Wow, that was really good. Yes, I think it's talkingrealmoney.com and meet an advisor. That button right there, you push that. And,
well, see, no one knew that until you said it.
That straight up. So do it. Yeah, happy to chat. So
do it. Oh, and a program note.
Oh, please.
This is a program note. Tom, just doing what Jeremy often does. Jeremy, our board op, is on perpetual vacation, except for today for some reason. I don't know why he came in today. But Tom our co-host, is also, he takes a lot of vacations. He does.
Stop it.
He does. He takes a lot of vacations, and he claims that this vacation. He claims this next vacation is for work.
No,
Funny, he's having a day of meetings. You did. You said I'm meeting with clients and
that's true.
In Phoenix. So it's a work trip, in quotes. But he's going to be staying. He's going to be meeting with people for like an hour and a half or something, and then the other 95 hours, I don't know, he's going to sit. Are you going to sit by a pool at some 5-star resort? He's not. He's gone away. He snuck away. All right. See, I embarrassed the heck out of him. So I'm going to be alone. The point is, I'm going to be alone next week. So on the 19th of April, when I do the show live, it's just going to be me. So come on by and keep me company. No matter what you have to say, if it has something to do with money, then we're going to talk about it. And, I want to help you with whatever means something to you, because this show is all about talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.